Markets appear to be ready to break out to the upside in the month of September. September does historically tend to be by far the worst month for markets over the past 10 years, but here in this video I will explain why September is going to be a strong month for stocks, specifically the data point that we have this Friday, if it comes in line with market expectations, is going to trigger a massive rally for markets. But we will also go over what to expect by the end of this year. And I will play this clip for you that is titled, "Our recession indicators are flashing red," says economist David Rosenberg. And I think these opinions are very valuable right now when the consensus is we've already achieved a soft landing. There's no recession coming. Like, for someone to say there's a recession coming right now when stocks are not pricing that in, when nobody is expecting that, I think that holds more value than the herd following the crowd, if you will. And there could be some real points here that are concerning. And here on this channel, it is my job that you are not blindsided by reality. At least I take it upon myself to make sure that does not happen. That is why I am not afraid to share my opinions, to sometimes be wrong, but hopefully be more right than wrong. But let's first, before we get into the negatives here, let's discuss what's working for us in the short term. Why September could actually be a very strong month for stocks, which I have mentioned in prior videos. Now I sound like a broken record here that keeps skipping and playing the same thing, but September has a 30% positivity rate, by far the worst positivity rate over the past 10 years. So in other words, you have a 70% chance of being red in the month of September. The average return in September over the past 10 years is negative 2.6%. The only other negative month is December, and you're negative 0.2%. You also have a 60% chance of historically being green over the past 10 years in December. So September is a terrible month. It is also an election year, which means September has more historical precedence in actually being a bad month. Because normally around September into October is when you get a lot of that election fear, election risk, and a seasonal correction. But I actually think you're probably not going to get that September correction this year. Mark Newton on X, he is the head of technical strategy over at Fundstrat, says never short a dull market, particularly when 5 sectors look set to make new all-time high monthly closes. Hibernation won't end just yet. And you can see this here. This is a chart from Mark Newton where you are getting these sectors that did just close at new monthly highs, which, if you're just looking at this chart arbitrarily and just taking this at face value and forgetting economic data, forgetting the Fed, forgetting all of the historical precedents around September, this would not be a chart I would want to short. Now, we do have to some degree, differentiate between the S&P and internals of our markets, like other sectors, healthcare, industrials, cyclicals, value, small caps, dividends, because those areas are not priced for perfection. Those areas do have some risk priced into them. So if we see the data this Friday, for an example, show us that, hey, the economy is not as bad as we thought. The labor market is holding up and the Fed's about to cut rates. Those areas should do much better than, let's call it, big tech. Big tech has thrived for the past 2 years because of increased recession risks via the Fed raising rates. Big tech has thrived because they have anywhere from $50 to $200 billion of cash on their balance sheets, sitting back and collecting 5% sweet interest. And that has really artificially boosted these companies' bottom line. You also have the fact that big tech is not relying on interest rates to sell more to their clients. Most big tech companies, if you really think about it, Google, Microsoft, they're selling to institutional clients. They're selling to other enterprises. They're much less directly affected by the consumer slowing down. In fact, a lot of big tech companies have advertising as a big segment of their business. Think about Microsoft, think about Meta, think about some of these big tech names. and their advertising business, Google for that matter, even Microsoft, right? They all have advertising to some degree in their business models. If consumers are pulling back, they're becoming more discretionary. That has even been boosted in that environment as well. Now let's imagine this. If the Fed starts cutting rates, you now have a lower chance of a recession. Rates start to fall, consumer can hopefully do a little bit better. There's less of a reason to own big tech. And there's more of a reason to own cyclicals, to own small caps, to own value and dividend yielders. If you own dividend stocks that pay 4 to 6% dividend yields, as the Fed cuts rates, those stocks will become more attractive and likely go up and their yields go down. And I guess I should also mention, with rates this high, there's not a lot of appetite to take risk. So companies like a Tesla or small cap, some of these other long duration growth stocks, they're really affected by that because one, inflation is higher, so long-term future earnings are worth less, and you can get 5% a year in 10-year treasuries for a little while there. I know it's around 3.8% today, but that still doesn't look that bad compared to taking risk in a company that is maybe going to succeed. Maybe not, maybe the company fails. So there's been a lot of reasons to stay away from small caps, to stay away from value, to stay away from cyclicals, and all of these other areas. Now, the biggest data point of this entire month, whether or not September, in other words, is going to be a good or bad month, will come down to September 6th. This Friday's non-farm payroll report. You're expecting 163,000 job ads. If you come in at that number, you could even come in slightly below, but nothing too far below. Really anything above like 150,000, 155,000 is going to be seen as good. Anything under that's going to be seen as bad. If you come in good, markets are really going to like that. I think the bigger thing the markets will pay attention to is the unemployment rate, in which, if the data comes in line with expectations, you're expecting the unemployment rate will fall from 4.3% down to 4.2%. And that's really going to boost those soft landing odds. And yes, as I have explained in other videos, I do think the data is very lagged, okay? I think the data that we're actually seeing for, let's say, this Friday's jobs report that is capturing data from August is more like June or July. I've said this a million times here on the channel. I think we can pretty much agree the data that we're getting is probably not that accurate. With that said, I'm not concerned about it coming in, bad. I think it's going to come in probably in line with estimates, and I think that's going to fuel a September rally for markets, especially as the Fed is set to cut rates September 18th. And I think the markets are going to look at this and say, yeah, soft landing achieved. Maybe the Fed, after all, is going to do the right thing and start lowering rates and, well, crisis averted. Whether or not that is true, I don't think we'll know until probably 2026. Why is that? Because I don't think we're really going to know if we have a soft landing until the federal funds rate is around neutral, which is between 3 and 3.5%. And at this current pace, as far as the last summary of economic projections, we're not going to know that or get to that level at least until mid-2026. So yeah, the threat of a recession will be with us for a long time. And I do think it's quite funny and quite ironic that markets talked about the lagged effects of raising rates, that it takes a long time to affect the economy, but we don't talk about as much of the lagged effects of cutting rates. The same lag applies. And to a large extent, I don't think the first couple rate cuts are going to do much for economic activity. So I still think in the longer sense of our markets, there will be a moment where recession fears will come to a head. There will be a moment in which we may or may not go into recession, but I think those fears will arise. I believe that's probably closer to the end of this year or in Q1 or Q2 of 2025. So I think we have some time here. And I think September is probably going to be a pretty good month in the meantime. Bar Chart posted this chart This says S&P 500 historical returns following the first Fed cut after 12 and 24 months. All are positive except in 2001 and 2007. 1 year later, you can see here, these are the returns upon the first Fed rate cut. You're 8.6% positive in 84. 87, you're up 18.8%. 89, you're up 6.5%. 1995, you're up 18.7%. 1998, you're up 22.5%. 2001, you were down 12.4%. 2007, you were down 18.9%. And 2019, you were up 12%. Now, the returns get much better if you're looking 2 years out, up 39.1% in 84, up 50.2% in 87, up 20.1% in 89, up 72.9% in 95, up 40.4% in 1998. In 2001, you were down 30.6%. 2 years later. 2007, you were down 26.3% 2 years later. And 2019, you were up 52.8% 2 years later. So it's pretty clear. If the Fed cuts rates into an economy that is not in a recession, that tends to be pretty dang positive for markets. And I think bottom line is markets don't want to give up on this soft landing narrative in the month of September, especially if the data comes in line with estimates. Now, if the unemployment rate comes in at 4.4%, if it actually goes up again, you're going to have a very bad September. Okay, very, very bad September. Even if it comes in at 4.3%, your odds of a bad September go up dramatically. But if we actually do see a tick down in the unemployment rate, it is going to be a full-blown green light for the month of September. With that said, up until this upcoming Friday, I know markets are closed on Monday, Tuesday, Wednesday, Thursday could be pretty dicey days. I'm not going to lie to you guys. I think seasonals for September being a bad month could come into play. I think there's going to be some people taking a risk-off approach to Friday's non-farm payrolls. And that makes a lot of sense. Like, if there's a risk that September could be down huge if Friday's unemployment rate disappoints, wouldn't you take some risk off the table as well? Yes. So from that standpoint, I'm really not bullish on most of this week. I'm really not even bullish on this week, if you just want to call it that. Friday, I think, could be a good day. But don't be surprised if there's some selling heading into Friday. Now, take a listen to this clip from David Rosenberg that says our recession indicators are flashing red.
So even though the Dow closed at another record high, our next guest is warning that he's seeing some recession indicators flashing red. David Rosenberg runs Rosenberg Research. I want you to really dive deep into the specifics here, David, because as we said, PCE came in where it's expected. You've got unemployment holding steady at 4.3%. You have some earnings reports that have surprised to the upside, even if stock performance has failed to follow suit. So where are you seeing warnings?
Well, for one thing, you're talking about earnings for the last quarter, which is in the rearview mirror. It's interesting to me that you're seeing the stock market go up, and yet earnings estimates for the rest of the year have actually started to come down over the course of the past couple of months. And there's been no change from the analysts for 2025. So this has been purely multiple expansion related. And you mentioned the consumer. And yeah, the consumer is really exceeding expectations. There's no doubt about it. But we have this wide divide right now that's really incredible, because real personal disposable income, after-tax income in real terms, is growing 1% over the past year. And your real consumer spending running almost 3% over the past year. So the fallout from that is we're seeing this relentless decline in the personal savings rate. This time last year, the savings rate was already pretty low at 4.5%. Today, it's 2.9. It's only been this low in the past 5% of the time. It's a 1 in 20 event. So I look at the consumer, I know what you're saying, but it's really the consumer spending report, I would say, is a low quality report because it's not being generated by real income growth. It's been generated by a continued drawdown of the savings rate to historically low levels. And when we talk about the recession, we've seen recession in real capital spending. The industrial sector is in recession, and the housing market has rolled back into recession. These aren't the biggest components of GDP. Of course, that's the consumer. But there are segments of the economy that are operating below the zero line. Admittedly, not the consumer ... Not yet. As for your comment on the unemployment rate, you know, it's not stable at all. It's gone up 80 basis points in the past year, and that's what's caught the eye of Jay Powell. That's the only reason why they're cutting interest rates, is they're concerned now that there's too much slack being built up in the jobs market. So that's the story, is that you're not seeing job loss, but the unemployment rate is going up, and Powell's already told us that is the most important statistic for him right now.
So, David, do you think that the Fed is behind the curve on this, or do you think that this was unavoidable? Just a two-pronged answer. And do you think that the recession, whether we're in one now or there's one that's coming, do you think that it's a first quarter next year issue or a fourth quarter this year?
Well, it's a no-brainer that the Fed's behind the curve, and the yield curve. Speaking of curves, I've been telling you that for quite a while. But Jay Powell told us that both at the last press conference after the July meeting, and then last week at Jackson Hole, when he's talking about how the economy is normalized. Inflation has normalized to a very large extent, and the labor market is not just normalized, but there's more slack in the labor market now than it was before COVID. So is he behind the curve? Well, you know, everything is normal except the Fed funds rate. And the Fed's own admission in terms of where its guesstimate of where neutral is 2.75%. That is the normal interest rate for a normalized economy. And the normalized economy is what the Fed's talking about. And they've got the funds rate of 5 3/8%. So recession or not, of course they're behind the curve.
Hey, David, it's Tim. Thanks for joining us. I guess I share that view, and I share your view, at least, that recession-proof, your term, sectors are places at least to be thinking about. It's fascinating that it's a year where you've had a bit of a barbell already. I mean, there certainly has been a very defensive play to the market if you look at what's been going on with gold, what's been going on with healthcare, certainly what's going on with utilities. How do you characterize what you do from here on out? Because based upon the moves we've had in some of those defensive spaces, that's telling you, it certainly is a read on some of the things you're thinking. Have we missed the move in some of these sectors that are not terribly cheap at this point?
Well, of course, what happens in those defensive sectors is that they get re-rated when investors start to see the economy cooling off. And the economy is cooling off. It's not in recession right now, and I think the consensus is that it's not going to go into recession. But, you know, we have the supply side of the economy expanding over 4%, and GDP, which is what we all focus on, let's assume it's running at 2.5 to 3. That's what I'm talking about, is we're building up disinflationary slack in the economy. So I think what's happening here is that interest rates have been coming down. The Fed hasn't cut yet, but market rate, and they will continue to come down. So I would say that certainly the rate-sensitive sectors in this environment get re-rated with a higher multiple, and I expect that that's going to continue. What I call the bonds and drag, you mentioned utilities, which of course has defensive growth characteristics too. Bonds and drag in the stock market, so whether you're talking REITs or telecom services, utilities, yes, I think that they're very appropriate right now and being re-rated appropriately because of the interest rate outlook.
So I'll just let that one marinate for a while. Let me know what you think about that down below in the comment section. Hit the like button as well as subscribe to the channel if you made it to the end of this video. Hopefully you learned something, at the very least gained a greater perspective of what could be coming next in markets, for better or for worse. We talked about both sides in this video. You guys have a great weekend. Remember, as I did not in the last video, that markets are closed on Mondays, so enjoy your extended weekends. And I will see you in the next one.